Uncle Sam wants you not to join the Army this time, but to pay the taxes you've avoided while saving for retirement. I'm Wes Wood, the income guy and founder and president of Wood Financial Group. And for nearly 20 years, I specialize in helping hardworking Americans just like you reach their retirement goals through income-based financial strategies. And hey, if you're looking for the right solutions to achieve your own financial goals, I can help. Just reach out to me at retiretv.com or by calling 855-776-0614 during today's show or at any time. As we all know, there's no such thing as a free lunch. That's certainly true when it comes to the government. So Uncle Sam gives you what seems like a free pass on taxes while you're growing your retirement savings, but that money really isn't tax-free. It's only tax-deferred. And that deferment ends when it's time to take out your RMDs, or what's called your required minimum distributions. That's when you need to start taking money out of your accounts every year and pay the taxes on it. And as with everything else, there's a right way to do it and there's a wrong way. The right way reduces the burden of your RMDs and your stress level, and the wrong way could put your retirement income at serious risk. And we're going to show you how on today's show, do your RMDs right. RMD basics. We're going to cover what, when, and how much. And we're going to discuss the biggest RMD mistakes you need to avoid. And finally, the right strategy for RMDs and how to get started. And joining me on this week's show is David Scranton. David is an investing for income specialist with over 30 years of experience. He's also a best-selling author and a television host. But before we welcome Dave, let's answer some of those basic questions about RMDs. Starting with, when did they start? And well, you might be aware of this, but the Secure Act was passed. The Secure Act was passed in 2019. And what it did, it actually raised the first distribution that you have to take out from age 70 and a half to say age 72. Specifically, the rule is you must start taking your RMD by April 1st of the year after you turn 72. And that RMD rule applies to all employer-sponsored retirement plans, including 401ks, 403bs, and 457s. And it also applies to traditional IRAs and IRA-based plans like your SEP IRAs, your SAR-SEPs, and your simple IRAs. But how much are you required to draw? Well, at first, your RMD equals about 4% of your IRA balance. Then, it's going to increase every year as you get older and as your life expectancy gets shorter. And you can calculate your increase for yourself by using the IRS publication 590-B. It gives you a table with a government assumed life expectancy for each age after the age of 72. Just take your balance of your IRAs and your qualified retirement accounts as of the balance of December 31st of the previous year and divide it by this life expectancy figure. I know it sounds simple, but remember, this is the IRS, so of course it isn't simple. There can be many complications depending on your situation. For example, there's a separate formula that exists for IRA owners whose spouses are more than 10 years younger. Usually that RMD ends up being quite a bit less. The bottom line is this, that you need to calculate your RMD correctly. Because if you don't, you're going to be hit with a whopping 50% penalty. So, now you know when to start your RMDs and how to calculate them. But now when you're taking them, how much are they going to be taxed? And we're going to talk about David Scranton in just a bit. And as always, you can hear more right now or at any time by visiting retiretv.com or by calling 855-776-0614 to receive your free retirement income kit. But right now, let's welcome David Scranton. He's the founder of Sound Income Strategies and the Retirement Income Store. David, thanks again for joining me this week.
As usual, it's great to be here with you, Wes.
Yes, sir.
So, give me your opinion. Yeah, I've got my theories. Give me your opinion. Why do you think the IRS, why do you think they pushed out the minimum distribution age from 70 and a half to 72?
I think they bumped it out 1.5 to 2 years because people are living longer. longer life expectancies, and they know people probably need to have more in their retirement savings accounts to retire, because now people are living, longer than just 20 years in retirement. People are living 30 years and maybe even a little bit longer. So it just gives people the opportunity to let the money grow a little bit longer. So it's probably longevity. At least that's my opinion.
Now, a moment ago, you implied that there are complications in some cases with calculating RMDs. Do you mind sharing two of the most common ones?
Yeah, there's two. So if you've got different retirement accounts, meaning if you have IRAs in one place, and then you have 401ks or 403bs or TSPs, employer-sponsored programs, left at an employer that's not yet been rolled over to an IRA, it becomes much more complicated because you can't just satisfy all the RMDs out of one of the buckets of money. For instance, if somebody has a 401k that's underperforming and their IRA is doing great, you can't just say, well, I'll just take my entire RMD out of the 401k account to satisfy the RMD money. It must come out of each bucket of money and use the calculation for each of them. That's one. The second one that's a common problem is some people that have immediate annuities. That is just like the 401ks, there's a firewall that exists between those types of accounts versus the other accounts that you may have. So you need to satisfy not only the RMD out of the annuity money, but also out of the other bucket of money as well. And most commonly, that's where we see people really kind of get in trouble and have to pay that huge 50% penalty because they failed to calculate their RMD correctly.
Now, somebody, just changing gears for a minute to taxes, somebody comes in your office and they say, they paid an average tax last year of 20.7%. And they think they could take the RMD and multiply it by 20.7 and figure out how much additional taxes are going to be due. But it's not that easy, right?
No, it's not. They're failing to look at the tax brackets. So their marginal tax rate is probably closer to 24, maybe even 28%. It's the highest bracket that you're in. Because we need to remember that RMDs are going to fall on top of all the other income. And that's just not it. The other thing is that it could complicate things because it could make it to where more of Social Security is taxable than it was before. So it's always good to get prepared for RMDs and understand what the tax could be and what it's going to be for you in retirement. And there may be some proactive things that can be done before we get to that point instead of just paying a heavy load in taxes. But hey, Dave, stay with us, and coming back after the break, we're going to talk more about the wrong way to do your RMDs. Stick around. I'm Wes Wood. You're watching the Retirement Income Show.
A fiduciary is someone legally obligated to act in your best interest. Doctors, lawyers, and some financial advisors are fiduciaries, but not all. When you work with Wes Wood and his team at Wood Financial Group, you are working with fiduciaries. They help clients create customized investment portfolios based off their retirement goals. If you're ready to work with a fiduciary, visit retiretv.com and schedule a free, no-obligation conversation with Wes or a Wood Financial Group advisor.
I'm David Scranton. During my career, I found that most baby boomers have done a great job growing their retirement savings, yet many don't know how to convert their savings into steady income. And that is why I built the Retirement Income Store, to help hardworking Americans preserve their assets and establish steady streams of income.
If you're 55 or older, please claim our free Retirement Income Kit, chock full of information you need to know to get steady income during your retirement. Call 866-714-7377, online at theretirementinComestore.com.